Hey, Bulls and Bears, how is everybody doing? It's your man JJ back here with another dose of economic reality. And it's been a couple days, right? I've been putting out less videos here lately, and we'll try to pack more into each video though, with the new plan, I guess, here, as you can call it, here from this channel. So thank you for everybody that's come back here. Please make sure you're still subscribed. And today we got a lot of good news on tap here with the economy, economic, financial news. We have the stock market bounced back from some pretty bad inflation data that came out in the past couple weeks. We're going to talk about that. We're going to talk about the housing market. The real estate saga continues with the median home price down about $50,000 nationally. We're going to get into the numbers and tell you what's behind that, and dig into some more real estate news here. We also have the bankers out there, the quote unquote leaders or the ones running the economy, talking about still forecasting interest rate cuts, even though inflation has not really been tamed. Of course, they're going to act like it's been tamed, but it has not been tamed. We're going to get into that here and some other news here. Let's go ahead and start right here. And taking a look here at the S&P 500, we saw this recent dip here after the inflation data came out, dipped under 5,000. We're back over 5,000 now. And it's interesting. I remember back, about 3 years ago now, just over 3 years ago, when the current quote unquote leader of the country, got put into office. There were talks that, the stock market's going to crash because, he doesn't have any economic experience, because he's older or whatnot, all these reasons why the stock market was going to crash. People didn't realize, and I never said this, but many people out there didn't realize that the one they tell you that's running the country doesn't run the country. It's the banks, and it's the money that's created that can prop up these markets, regardless of how many bad economic policies or decisions are made by the person sitting behind the desk or someone sitting, in an office of leadership, quote unquote leadership. Regardless of all that, it's all about the money creation, right? If they can throw enough money at the problem, you can really change the course of the economy and the course of what markets do. And that's what I've tried to get people here to, to really open your eyes to and realize what's going on here. I'll give you one of many examples. Here's one. 99.9% of the people following the economy and creators, economists, they said the housing market was going to crash just because home prices were higher than 2008, and because incomes were more detached from home prices this time versus 2008. And I think I was the only channel on YouTube to tell you, no, there wasn't going to be a crash. You'd probably see a correction. And that's what's happened here. And we'll talk about the prices here in just a moment, but no crash. Banks are still loaning out money, and credit card companies are not dropping credit limits. Those were things that did happen in 2008 that caused a lot of layoffs. Layoffs spiked because as consumer spending really took a sharp drop, jobs were lost very quickly. And that's what would happen again if credit card companies were to really drop credit limits and credit ceilings and pull back on the amount of money or the amount of debt that people can swipe their cards and run up, right? That's what it's about. It's about consumer spending mostly. Now, when you look at the government data, the numbers, a lot of that is government spending, all this money being sent overseas for wars and funding weapons. That gets put into the economic numbers, and it shows up as economic growth. So the more money people take on, the more money the nation takes on under the national debt, the more money that's spent. It's borrowed and then spent, but the more money that's spent, even though it's borrowed money, that gets chalked up in the economic numbers, and it makes things look pretty good. And actually, if you look at the latest consumer data over the last 3 months, consumer confidence has slightly grown, according to one survey. There's other surveys out there saying people are getting more and more concerned. But I think overall, people have just the expectation of unlimited debt creation, the unlimited borrowing that's going to keep themselves, be able to make these purchases. All right. But the stock market shook off that inflation news that came out, where inflation came in higher than expected. And, you have to remember too, the stock market, just like the housing market, it's based on how much money can be borrowed. We have investment firms out there, institutions borrowing money, not as cheap as it was, but still being able to borrow money. If they can make a profit of more than it costs to borrow the money, then they're going to continue to do that. So, in my opinion, you'd have to see the funds rate, the Fed funds rate, spike up to 10% or higher in order to really have an impact on the markets. And I'm talking about the housing market, the stock market. It's all about borrowed money. It's all about money creation, uh, debt, throwing money at the problem. And until that reverses, we're not going to see this deflationary situation or the crash that many people have expected. But speaking of price corrections in the housing market, let's go ahead and get into it right now. And we've been following this data here for a while. We know that home prices are down. But here's some recent news here. And just bring this up here. The median sales price of a home in the U.S. has fallen now to $430,000. And that was from the peak of $480,000 in the fourth quarter of 2022. So this has been a very gradual decline. Some people will say, based on home prices now, that $50,000 is not a very big price drop. Well, if it would have dropped that far in, let's say, 6 months, that would have been pretty big, a $50,000 price drop. But the fact that it's taken since the end of 2022, here we are over a year later, and we're just down $50,000. A lot of people really aren't really seeing or noticing the difference in home prices. But at least if you want some good news, there's some good news. Home prices didn't go up. In some areas, they actually did. When you compile all the different markets across the U.S., home prices are down. Quote, "I never dreamed I would spend this much for a house," unquote, said Caitlin LeClaire, a homeowner in Wayland, Massachusetts. And that's what people have decided to do. A lot of people that I know personally that were going to hold off on buying a house, they went ahead and pulled the trigger. They went ahead and bought because prices didn't crash as they expected, and you have to make your decisions based on timelines. Do you think something's going to change in the near future to reverse the way that money's loaned out and reverse this whole debt-driven economic situation? I don't think so. I think 2008 was one of the last deflationary events that we're going to see. And I think it's going to be just more throwing money at the problem. I think inflation is going to be the thing that's on the table for the most part. It doesn't mean we won't see some price corrections. Obviously, $50,000 in the housing market off the median price. Car prices, depending on what type of vehicle you're talking about, down anywhere between 8 and 20% over the past year, which is pretty significant. Electric cars down even more, down like 30 something percent, 35% for most Teslas. So opportunities are popping up here and there, but for the most part, we're still seeing a lot of cost of living problems out there, a lot of inflation. Debt is still climbing for the average household, and the question is still out there: how much longer can most households survive under this amount of debt? And some people say you can keep on robbing Peter to pay Paul, so to speak, for a very, very long time. And that seems to be what's happening here. Well, let's get into some other news here. Recent words here out of the bankers here, the ones that run the economy, the ones that decide what the interest rates are. Rate cuts still, they're in talks of still doing rate cuts, even though the inflation number came out, it was much higher than they wanted or higher than they expected. So prepare for more inflation, folks. It looks like they're going to be in a different mode than they were in 2008. In 2008, the money stopped for the most part. It really slowed down. The lending stopped. It was very hard to get a home loan. Credit card limits were dropped. Consumer spending drastically took a dive, dropped off of a cliff. That caused a massive spike in unemployment and layoffs, and the unemployment rate spiked up to over 10%, very quickly. And now we're still down below 4% because we're not seeing that type of credit contraction. We're not seeing the credit contraction that we saw back then, right? So we got to kind of navigate this and see what's going on. Don't just think that 2008 is going to repeat itself again, because remember, in a manipulated market, manipulated economy, the past doesn't predict the future. The past doesn't determine what's going to happen in the future, because if the types of reactions are different, or the types of manipulations are different now than they were back then, you're not going to see the same things happen, even though prices are higher, debt's higher. You have to kind of think outside the box, so to speak. And I think that's why most people probably didn't get it right, because most people are just looking at the past, expecting the same thing to happen in the future. Let's talk about this. Will commercial real estate trigger the next financial crisis? Well, when you look at the loans these commercial real estate loans and a lot of these banks severely underwater. Some of them have lost 50% of their value. So will there be enough money to come in and buy up all these troubled assets? It's possible. Remember, they can create trillions of dollars at the click of a mouse and come in and buy up all these troubled assets, all these toxic loans, all these underwater loans at the click of a mouse. Will that happen? I don't know. I hope not. But you have to prepare for the worst, and I think that's going to be the worst case scenario. In this case, I think deflation and falling prices would be the best case scenario, but I don't think we're going to see that. I think we're going to see a lot of smaller and regional banks fail, but they'll probably get their assets bought up by some of the big, larger banks. And the big, larger banks, they're going to be liquefied and propped up no matter what. So don't expect any sort of deflationary collapse, in my opinion, unless we see some sort of act of World War III or something like that, something big. It's going to take something big to derail this economic structure that's been stacked up here and the way they've decided to run the economy, right? So keep that in mind, folks. And you've got to look for investments, look for ways to grow your wealth, with this. And this is not all about money or greed, but this is about survival. And we live in a time where if you don't have enough money, you won't survive. You're going to be on the streets, and it's going to be very difficult to survive on the streets. So that's the bottom line here. So my focus here is not so much about getting rich. Of course, it would be nice, and I've made some money. I could probably retire now if it were just me. But now I've got a family, I've got young people to think about, so I'm not just going to retire. I'm going to try to put away as much as I can to help my youngins here, so to speak, young people in my family, because the future is going to be very, very difficult, I think, for a lot of the young people, and that's what I'm concerned about. Not just for my young people in my family, but just overall, just the younger people here. But everybody too. I see stories of seniors losing their homes. Speaking of that, we said here on this channel there were going to be a lot more rescue programs coming out. Another form of manipulation and keeping a financial Armageddon from happening. Well, that information here recently came out. More propping up, more rescue programs have been implemented. In fact, let me find the article here. The U.S., it's out of Bloomberg, the U.S. will buy missed mortgage payments for those veterans. Remember the stories that we reported on here, how behind veterans were. A lot of these VA loans went bad. Veterans were having a very difficult time making their mortgage payments. So what do we see here? We see the U.S. buying these, or covering these missed mortgage payments from lenders to halt foreclosures. So there we go. So again, to people predicting a real estate market crash, the housing bubble going bust, a massive surge in foreclosures, I can look around on the web right now and find dozens and dozens of channels that have been predicting a foreclosure tsunami. Remember, for that to happen, you'd have to stop all the rescue programs. You would have to have a big crackdown in lending and prevent banks from loaning out so much money. You'd have to have both of those things happen. I don't see that happening, folks. So any more house pricing corrections, I think, will be small, just like $50,000 median price correction in over a year, which is pretty significant, but it's not the crash that most people had predicted, right? So bottom line, folks, continue to expect cost of living to be trouble and invest accordingly. We're going to wrap this one up here. I'm going to try to be more consistent on the output here of the videos of this channel. So if you like what we talk about here, please make sure you like, hit that notification bell, and subscribe if you're not subscribed, and help us stay alive here on this platform. Thank you guys very much, guys and girls, everyone in between. Thank you for watching. Bye for now. Peace.